Good afternoon, everyone. Thank you for joining us this afternoon. We're just letting everyone in through the waiting room. You've all been patiently sitting for a little while. Thank you for joining us for the final of our webinar series for this year. I'll just give it a moment for everyone to come in and get their audio connected and get all those things happening that technology does. Through that. Okay, so for those who are here, we'll get cracking for the day. So thank you very much for joining us for what is the last webinar for this calendar year, the 2024-14, almost lost a decade already. So thank you all for joining us. After the last couple of months where we've had the ATO and we had the IT guys on. You're back to just me this month, so we're going to have a look at some things to be sort of cautionary tale stuff to have a look at and keep an eye on over December and January. Things that this time of year can cause all sorts of grief for small business, as we know. But please feel free if you've got any questions or comments that you can throw them in the chat. And if you'd prefer to say them out loud, then just put in the chat that you've got a question, and then we can organise to unmute you if that's what we need to do. But before we get into it, I'll just sort of just do a little bit of the general update as I normally do. I think there's no doubt that everyone would have seen in the press over the last couple of weeks the latest numbers are starting to come out for the month and the previous quarter. I think probably one of the big numbers that will affect all of us is that the business failure rate has increased quite significantly. It's now up to 5% of all businesses are likely to fail, or 5.04% is the business failure rate, which is up from 3.97 in October of 2023. So in 12 months, we've gone up a full percentage point. Which is a significant increase that I don't know that any of us were surprised is starting to happen. But between the combination of interest rates, cost of living, wage increases, all those different things that have impact on business and on people's personally, there's no doubt that those impacts are starting to flow through. And I still think we've got a way to go with a number of that. But when you look at it on the industry by industry basis, unsurprisingly, food and beverage is now at the top of the tree. They've overtaken construction quite rapidly. So up to just shy of 10%. So 8.5% of food and beverage businesses are now considered to be at that business within the business failure rate, which is quite a staggering number for us all to be a little bit concerned about. And there's not many days go past where we don't see a new cafe or restaurant boarded up or shut up around the place these days. So admin and support services is second, and actual construction has actually moved down to fifth spot on the ladder at the moment. So a little bit surprising that they've dropped off so quickly, but then there has been some very significant numbers coming through over the last period of time. Now, I guess the comment around all of that, so the normal stuff that everyone hears about, the interest rates, cost of living is meaning, particularly in food and beverage, people aren't going out. Most businesses are finding there's a real profit squeeze happening on their business, so therefore they're not spending some of those ancillary expenses that you would normally see in the particularly in that admin and support service area. But the other thing, of course, and quite naturally, is that people are starting to chase their money. Everyone talks heavily about the ATO, and I'm certainly not going to shy away from them being a big part of the process. But overall court actions have actually increased 13% year on year. So we've now seeing a lot more people going to court and chasing And I'll talk a little bit more about the impact of that and how that flows through as we go through today. But there's, and again, without a doubt, the ATO is in significant cash in collection mode at the moment. For those who get some of the accounting journal stuff that comes out each day, you would have seen there was what they were spruiking is a huge increase in director penalty notices on superannuation, saying something like 8,500 director penalty notices issued on super alone. That article talked about there being about $2 billion in outstanding super, and only 10% of that is actually in a payment plan. So about 200 million. So there's a significant hole there in terms of being able to collect out on that superannuation and get that paid back to staff. It's certainly we see with businesses that are in trouble, that is certainly one area that can be neglected and regularly neglected by directors, because it's not one that's easily and you know, it still appears on everyone's pay slips, but they don't know it's not being paid. Similar to PAYG and GST, which is pretty standard. Unfortunately, super falls in that basket as well. Although, in fairness, you do see a lot of directors will actually pay super before they even pay themselves because they want to do the right thing. So you can have two sides of the coin on that. But anyone who's not paying it, it would appear by the articles at the moment that a large percentage of people aren't trying to fix that problem either. And when I'll talk a little bit more about personal bankruptcy, that flows into that quite significantly and quite fast as well. The collection methods of the ATO are certainly getting more aggressive as well. We're seeing a huge increase in garnishee notices, which Anita from the ATO highlighted a couple of months ago that was one of their tools. For me personally, and over 18 years of being in the game, I don't know that I've ever seen as many garnishees being issued as we're seeing now. So normally it would be every now and again you'd see it, but pretty much on any file that the ATO is progressing on the collection cycle, they're doing a garnishee hit on the bank account, and then potentially looking at on FPOS facilities, on debtors, and out of wages where it's at a personal level as well. So they're certainly not missing their opportunity to try and get their pound of flesh. So it's something to be mindful of. Now, for you as advisors, if you're talking to a client who has some outstanding debt, isn't really dealing with it properly, one of the things to be careful of with the garnishee notice is that generally the account that they go after first is the one that was put on the BAS originally. So the original company account when you set up the ABN number. If they haven't moved, or if they've updated those bank account details with the ATO, be mindful that would be their first target point. So, for instance, if they bank with Westpac, they will issue a garnishee notice on a particular bank account that you might have given them when you first set up the ABN, but they'll also say to Westpac, any bank account in the company name. So it doesn't have to be the account that's there. So one thing that we'll often talk to clients about is making sure that they've got a bank account with a different bank from the one that the ATO knows about. Doesn't mean they can't garnishee that one as well, but it can make it a little bit harder for them to get their hands on it in a quick succession. And look, garnishees are ridiculously hurtful to a business because generally, you know, the money that they're holding to pay bills and pay their staff are sitting in the bank account that then gets attacked. So just something to be mindful of as advisors. If you do have those clients with some outstanding debt and some outstanding pressure, just to start thinking proactively about how you may be able to protect them from losing that money. So they're just some of the little bits and pieces that we're seeing from an industry point of view. Numbers are certainly higher than everywhere, but that's, you know, you're hearing that everywhere. So it's just something that I don't think is going to go away for a while. In my opinion, I think 2025 is probably going to be a tougher year in business than we've had this year. And I don't think there's many of us that don't think it's been a little bit tough this year as well. So I think we've still got a ways to go for all of that to flow through. The other thing, and again, I'll jump back on some of these points, but the other thing that is being talked about a lot at the moment in the press is the business deficit days. So how long it's taking for a debtor to pay their bill. That's increasing quite exceptionally as well. During COVID, it actually got down to one of its lowest numbers in history. We're now getting out to mid-70 days for payment of an invoice. And so it's pushing out. It's taking longer to get paid now than it ever has before. But the purpose of today, I really wanted to talk about some of the things to think about for your clients, and maybe, you know, with a business failure rate of over 5%, we've all got clients that are more than likely going to have some sort of faltering that they're going to need to deal with. But Christmas in and of itself, Christmas in January, can be a really disastrous time for certain businesses. So the first one I want to highlight is for the type of businesses that actually have shutdown periods. So if you take a factory, for instance, or anyone in the construction game, they often shut down for 2 to 3 weeks, or even 4 in some cases, from just before Christmas through to mid-January. Now, every year we'll end up getting a phone call with someone going, "Oh, we're about to shut down in the next week, and I can't find the money to pay my staff wages." Now, as tragic as that sounds, and trust me, when you've got to be the one that tells all the staff that they're not going to get paid their Christmas holiday pay, it is a really tragic situation. It happens every year. Now, we see a very small percentage of the total market, so we know it happens quite a bit out there. So if you have clients that are of that type of industry where they do have the shutdowns, and you know that they're already on the brink a little bit, it may be worth talking to them now about their ability to have the money that they're going to need for the Christmas shutdown period. Not only does Christmas shutdown cause a massive cash burden because you've got to pay out all these wages right on the last day with all the holiday pay, but on top of that, because you shut down for 4 weeks, by the time you ramp up and get going again, there's often a couple of months worth of non-payment of income coming into the business. Now, when you've got plenty of cash, that's not really a problem. But now that we've spent the last 12 months with a lot of businesses that are basically living hand to mouth, and they don't have that extra money up their sleeve, it can cause a lot of grief both before and certainly afterwards in how you actually get up and running again. So be mindful of having those clients. There are, in some cases, there's things that you can do. But again, even if you look at, say, the debtor book, for instance, and you might think about using debtor finance because you know that debtors are going to take longer to pay, it's a bit of a sugar hit that might help the business get through, but we've got to look at some of the longer term impacts. But identifying it now at least gives you 4 weeks to come up with a plan to deal with it, rather than, I think last year I had a client that rang up on the 18th of December, said, "I'm not going to be able to pay my wages next week. I need to appoint a liquidator next week." So, you've got a week to get things organised. Now, you may still end up needing to appoint a liquidator or put an administrator in or something like that. But if you've got a month, you've got a bit of time to make sure that things are set up right and set up the best way possible for both the director, the staff, and whatever's left of the business as you work your way through it. So that's probably one of the first ones that I identify. As I say, it happens every year. We do see companies that will end up putting themselves into liquidation right on the Christmas period. Sometimes it's because of the staff wages. Sometimes there's other factors. They're just working right up to the edge and then going out the back door after that. The other side of that around Christmas and New Year, the other thing that can happen is you get the opposite. Now is the time where businesses are really raking in the cash, particularly in the retail, food and beverage sector, in the catering and accommodation areas. All of those type of industries do very well in the lead up. Most of us as advisors know that everyone wants to get all that stuff done before Christmas. So we're always getting the phone call saying, I'd love to get these financials sorted before Christmas, get my tax returns done before Christmas, all those different types of things. So there are certain industries that will have a bit of a buffer now. Then the problem comes with a lot of those, and particularly in the retail and hospitality sectors. What we find is, and this year is even worse, is that the profit margins are so fine that they enjoy the sugar hit of having the extra cash in the bank, but they don't allow for any of that to stay around for when we need to pay all the bills associated with it in January and when we need to pay the BAS in February. So their bank accounts can actually get quite a little bit filled at this time of year. They start feeling quite confident that everything's going to be okay. They get the false confidence that the world's great, and then everything sort of starts shutting down again around mid-January, and they don't have the money now to pay the bills, to cover all the extra stock they might have got in, or any of those number of things. And particularly, and there's no doubt I'll talk about this in January or February when our webinars start back up again, is that we've got BASs due on the 28th of Feb, and there's a significant amount of those that won't be able to be paid because they'll have used that money up in the meantime. So if you've got businesses in either of those two circumstances, making sure they've got some idea of how to plan around those two events, both the positive event of the extra cash or the big hit of not having cash coming in for a while, it's certainly something that now's the time to be planning for that a month out. You could say it probably should have happened 6 months ago, but let's go with small businesses that look about a month ahead if you're lucky. So now's the time to be going, okay, do I have any of those clients? Maybe I should be having a chat to them. How's their ATO position? Because if I'm telling you that there's extra money in the coffers of retail and hospitality, I can guarantee you the ATO know, which may then lead to other garnishee notices if they're being a little bit delinquent. They are certainly aggressive enough at the moment that they'll use any advantage they can to get themselves ahead of it. So they're probably two of the big ones that we're seeing a lot happen for businesses that are trying to work their way through. The other thing that we often see at Christmas and the New Year, and I was saying this morning that Hank and I pretty much are guaranteed that somewhere over the Christmas New Year period, we'll get a phone call from someone going, mate, I've sat on my chair for a couple of days now, the phone's been off, I've done the Christmas thing, I've watched the Boxing Day test first day, and then they've gone, I've had enough. I cannot put myself through the stress of running this business again next year. So getting out of business is often something that, and I for some of you who've listened to me before, you'd know that I've talked about this quite a bit, is that people are just getting tired of being in business. I think for a lot, there was a real period of growth and businesses were doing quite well and there was plenty of money to be made around the place. Now you've got to be really sharp, and you make one mistake and you could be in the red very, very quickly in business at the moment. Sorry, I forgot to turn one of my notifications off, so it just popped up in the middle of me trying to talk. So it's certainly, controlled exits, that's where we were. So we will always get clients who want to do that over Christmas and said that decided they've had enough. I've spoken about it for over many years about this being a trend that started occurring more on the back of COVID, that people are just sick and just can't be bothered doing it anymore. Now, what I really want to highlight is that when people do that, if they're not in the mindset where they just want to shut it down tomorrow, but they are in the mindset that they'd like to get something out of the business, then there are ways of managing the business over a couple of months to get to a sale and to liquidate. I say sale and liquidate There's quite often what happens is people are actually, when they look at their business, they look at how much debt's in there, and if they can sell it for the amount of debt that's in the business, what they'll do is that they'll put it on a market and it'll never sell. It's too high a price. But if you've got a strategy that allows you to sell it for what the market will bear, then you have a liquidation phase of it after you've sold the business out. You can then liquidate and deal with some of the other debt that might exist in the business. I'll give you an example that wasn't over December, January, but it's one of a couple of directors that had enough. There was a small cafe that really, it was just a breakfast lunch cafe. They'd been running the business for 6 years, all the way through COVID, doing okay, but nothing great. But what they had done, like a lot do, is that they had accumulated some ATO debt. They'd managed most of their suppliers were okay, but they'd been starting to have to put their own money in and went, that enough's enough. When we spoke to them, I said to them, look, for some reason, cafes are actually selling at the moment, so get it on the market quickly. Now, when they started talking to the broker said, well, yeah, probably be able to sell it for about $100,000 to $120,000. They had nearly 200 grand's worth of debt, and the business owed them another $100,000 in money that they'd put in both at the start and through the process. Now, if they would just go to the market without sort of understanding what the plan may have been, they would have gone to the market saying, we need 300 grand to get out of this. It was never going to sell for 300, but at 100,000, they could get some of all of their creditors paid. They can get some of their suppliers and the ATO paid, a percentage of it. Because they were unsecured creditors as well, they were able to get some of their own money back out. And then we can deal with the rest by the liquidation of the company. Now, the reason why that can be really handy if they've got a bit of energy that can handle to get them through a couple of months is that it takes care of landlords. It hands over a number of other issues that would otherwise come if you said that you wanted to shut down tomorrow. Now, if a client wants to shut down tomorrow, there's certainly ways that can be managed. But what I wanted to highlight really here is that if you have those clients going, I think I've had enough, I really don't want to be here, there are strategies that will allow us to get a quick enough sale and a completion of the business to allow people to get on with their life without having to put hundreds of thousands of dollars still into the business. And that's a big thing that happens over Christmas, is that we find a lot of people, they take that week off. I think, most of you here listening, I know, are all in business for yourselves or working in small businesses, and you just don't get time to think. You're busy, you're flat out all the time, particularly talking to accountants and, well, all of you, accountants, lawyers, bookkeepers, all of you are flat out at the moment, and we don't get time to sit back and think. And that's the same for most small business owners. They're fighting every day. When they get that small break, it's amazing how quickly the mind can change and go, do I really want to put myself through this again? If they do, then they battle on. But there are a lot of people that don't, and now's the time to start think. Well, most of them won't think about it till January, but when they do think about it, then I want you to realise that there are options for them to get out quickly and efficiently, and hopefully at not such a personal cost and burden to them. Another thing that I'll repeat from this morning, I had a question that came up this morning about we often talk about corporate debt and corporate DPNs and all the rest of it, but there are still a large amount of businesses out there that are operating as a sole trader. Now, I not a fan of sole trader. I think anyone who goes into business should try and at least use a little bit of the corporate veil to their advantage. But there are still a lot out there that are sole traders. And what the question was is that what we can do to help clients who have ATO debt as a sole trader. Now, the bad news is there's not anywhere near as many options to try and protect them. If they're willing to go bankrupt, we've obviously got options there. If they don't want to go bankrupt, then you have limited options to deal with it in a solvency scenario. But we did talk a little bit about a Part 10. So I don't know how many have come across it. They go in and out of flavour, both with the ATO, who is often the primary creditor, and just with the market in general. But a Part 10 is very similar to an SBR or a VA in DOCA, meaning that there's an offer made to creditors for a settlement of the debt. So it is another way of going through the process and helping get a resolution. At the moment, we're finding that, again, the ATO is often the major creditor. They're being relatively supportive of them. And we've had some success recently with Part 10s for people. But they can be a very good tool if you have directors who've got certain licenses or memberships that bankruptcy don't allow them to keep through. So, for instance, if you're a real estate agent and you've got yourself into some trouble, if you go bankrupt, there's a chance that you will lose your license to operate as a real estate agent. Now, I'm not talking about those with a trust account, because trust account's a whole different component. But even as a real estate rep, as a bankrupt, then there are some significant issues in being able to stay in business. But in a Part 10, you can roll through that process because you haven't actually done, in their minds, the ultimate act of going into bankruptcy. So if you do have clients who have got significant personal debt, then there are still options for them that don't include bankruptcy. There is what they call a Part 9 as well, which is generally for smaller debts. It's got some limits around it as to whether you can qualify or don't qualify. And Part 9 is certainly an option. I think, as I said on previously, if you stay up late watching late night TV, they often, the debt busters and the Fox Symes and all that sort of thing, they use Part 9s as the way of helping people through. Now, the other thing I wanted to say on bankruptcy is just to be, there's a lot of people who will come to us and go, I can't go bankrupt, I can't go bankrupt. And when you break down and look at why they can't go bankrupt, it's more of an understanding or a lack of understanding of what bankruptcy is about. Now, some of you will have heard this before from me, and you may have heard it from others in the firm as well. But the Bankruptcy Act is not a penal act. It's not there to actually say you're a bad boy and give you a slap across the back of the head for not making your payments and not being able to pay all your bills. The Bankruptcy Act is actually designed to be a protective act. It's there to actually help almost put a wall around you and say, here, all of your debts are going to be captured within this wall. We'll put the wall up to protect you from all of that, everyone attacking you and annoying you and chasing you over it. But there are certain costs and privileges that you have limited during your period of bankruptcy to enable us to give you that protection. Now, one of the big fallacies is how much you can earn in bankruptcy. There is actually no limit to what you can earn while you're in bankruptcy. What there is, though, is that as part of that protection mechanism, if you earn over the threshold limit, and for a bankrupt with, let's say, 2 dependents, it's about $100,000 that they can earn before they need to provide any contributions back to the trustee. Now, please don't hold me to 100,000 because it's quite a convoluted scale to work through. If you look on the AFSA website, they actually give you the contribution limits on an after-tax amount, which is different again. But what it means by getting to the contribution level is that, let's say the limit was 100,000 for simple sake terms, and you had a bankrupt that was earning $110,000. The way the system works is that you take tax off that 10,000 first. So therefore, out of that 10,000 that's over the limit, the tax comes off first. Call it 30%, just for simple sake. that means that there's $7,000 left. Under the legislation, 50% of that 7,000 needs to be provided to the trustee, almost in payment of your protection from your creditors. The other 3,500 you get to keep as the bankrupt, and you can continue to live your life with that extra money. So earning over the threshold is okay. You still end up in a cash positive position, but you do need to give up some of it for the protection. The other one, which I find absolutely staggering every time we deal with someone who needs to go bankrupt, is they ask about going or traveling internationally. I've joked about this before, that I'll often ask the question, do you travel overseas often? And they'll go, no, I've never traveled overseas. Then why do you care if you can? Oh, I just want to know. But the reality is you can travel overseas most of the time. You just need to get permission first. You need to show that you haven't got a whole bunch of cash under the bed and you're just going off gallivanting around. You've got to show where the money's coming from, which often comes from a spouse paying for the holiday, or if it's a work trip internationally, then work will pay for it. And you've got to provide an itinerary so you don't end up being a Christopher Skase and hiding in some little island on the other side of the world. But to travel overseas and come back is quite normal. There's generally no drama with that. And in some cases, I've seen bankrupts that have actually traveled overseas for 2.5 years of their bankruptcy, both working and providing their reports back to the trustee. So you can travel for extended periods of time if needed overseas. The reason why I bring all of that up is that we are going to go into a period where we're going to see a lot of directors who are going to probably have to think about bankruptcy. There are so many expired director penalty notices out there. There are so many people with integrated client accounts that have got BASs that they didn't lodge on time because they were worried about not having the money. So they will end up with lockdown director penalty notices in due course. Managing and preparing someone for bankruptcy is obviously a specialty of what we do, but it's also not the end of the world. And getting an understanding that doing it, setting it up and doing it the right way will actually help people survive and get through the process quite well. So that all started from a question this morning about how to deal with someone who's got tax debt in their sole trader. But I think it's important for people to understand that we talk predominantly corporate, or I talk predominantly corporately. But one of the big things that we do, and sometimes we probably underplay this because it's so natural for the Jonge strategists, is that when we meet with a client, we never just look at the corporate only or the personal only, unless it is only a personal debt. But if it's corporate, we'll also look at the flow through impact to someone personally. And one of the things that we are seeing a little bit of at the moment is that there's been such a huge marketing push towards these SBRs that we're seeing a lot of directors are going direct to a practitioner and going, oh, well, we only need the one fee to pay them, and they'll get through the SBR, and sometimes they get through it very well. I'm not denying that the practitioners know what they're doing there, but they don't recognize the impact personally. And I got an example of a client that in the retail space, to try and find their way through, they'd ended up with a Prosper loan. They've got 3 creditors who are trade creditors of theirs that have got caveatable interests and personal guarantees, and they've got 2 other smaller fintech loans. They were convinced that the best thing to do was to go through an SBR, which they did. It was successful. It got accepted at I think it was 28.5 cents in the dollar. But what no one prepared them for was that all of those creditors that had personal guarantees could then claim after them for the rest. So as soon as the SBR was accepted, probably within about 3 weeks, the demand letters started coming personally. And because there was a default, some of them became very aggressive very quickly. So it's important when any client, and when you're talking to a client about what's our approach, what's our plan, how can we get through, is making sure that we look at it really holistically. What's going to happen corporately? How's that going to work? Yeah, I'm going to get a bonus of 30 cents in the dollar, and I'm going to pay all my creditors that. But how many of them have got personal guarantees? How many of them have got caveatable interest that can then attack the director personally? And in this case, that actually created a really significant impact on them personally. It put the marriage under even more pressure because all of a sudden we're getting all these caveats lodged on houses, on the family home, which is creating a whole lot of stress now leading into Christmas. So and because you don't plan for it early, what your options are more limited because you didn't deal with it at the front end. So again, selling our own, part of I guess what we do on a webinar. For me, it's more about information, but every now and again you've got to go, hey, it's Jonge Reed there as well. Is that we provide independent, holistic advice across all facets of what's going to happen, and getting that advice early enough is really important, because otherwise you can end up with all these extra attacks, and it's much harder to negotiate with a creditor who's got a caveat on your house to someone who you're talking to early before all of that's happened. So they're the sort of things that need to be addressed early in a scenario, so that you can actually then work it out. The other thing I will mention, because it's actually a bit surprising, is that the ATO are actually making a lot of mistakes on the director penalty notices, particularly if there is a company that's already in liquidation. We're finding that they're issuing director penalty notices, and I've even got one client where they've issued a statement of a claim against the client when they haven't recognised the liquidation properly. So if you have clients that come to you with some of these demands and they thought they dealt with it through a liquidation, whether it be with us or not, give us a call, talk to us about it, because there are some things, as I say, they are actually getting them wrong. And that probably another thing that sort of leads me into is just the quite often, and I think even a couple of months ago I may have spoken about that the ATO are very focused on the corporate. They'll issue the director penalty notices, they'll do all those things that they can personally, but then they come back and attack the corporate. What we're finding now is that when we put a company into liquidation, if there are personal guarantees or if there are director penalty notices that have expired, they're attacking on those very quickly now. It used to be almost a year would go by and you had plenty of time. I put a company into liquidation. I helped put a company into liquidation about 4 weeks ago. And last week, that client received a garnishee notice on his personal bank account. And the demand letters and stuff had come. So they're attacking very quickly at the personal level now. So again, having both the corporate and personal plan in place needs to be something to be considered, because they are attacking personally very quickly. That's pretty much a lot of what I wanted to cover off and talk about today. If anyone's got any questions, comments, please, happy to go down whatever rabbit hole there is. So if there's something that you've seen recently that you're not sure about, if there's something that you want to ask about, please pop a note in there in the chat group now. While people hopefully are typing, the one other thing that I will say, and this came up in one of the accounting journals as well, is that the ATO are now attacking entire groups. Now, what I mean by that is that if you've got a client that has one company that might be particularly under stress, but they might have 2 or 3 other companies in the group, when their file gets picked up, and there's still a mystery as to when it's your turn and when it's not, But when your file does get picked up, they used to just look at that one company, the file that was, may have had the debt. What we're finding now, and as I say, it was also in the journals, is that once they pick it up, they go, all right, who's the director? And then they look at all of the companies that director's got, and then they potentially attack all of those. So I had a client that's been with us for about 6 months. We've been doing a bit of asset protection work before we're getting ready for the liquidation. 4 companies in his group, 4 companies in the group. One of them is got a particularly sizable debt. The others were probably, compared to the other debt, it's a debt of about $500,000. In his other companies, he had about 100,000 in each. Now, most of that 100,000 ones he could clear up relatively quickly, but none of them were in formal payment plans. When they picked up the file, primarily for the debt where it was $500,000, they issued director penalty notices on that company on day one. But when they rang him up and said, we're going to issue these, they also said, we're going to do it across all the other companies in your group as well. So within 48 hours, he'd actually received director penalty notices on all 4 companies, and they'd garnished 3 of them. So just, again, something to be mindful of. Having a diverse group, and none of these businesses were really tied to each other, and even to the extent that state revenue didn't even see them as joint companies, because the businesses were so different. But when they picked up the file for one, they're then going after everything. So just again, for those of you who've got clients with groups of companies, if there's one of them that's potentially causing some grief to the group, then you may need to be aware that they'll attack the entire group. Now, they can't cross, like if they pull 100 grand out of one company, they can't, from a garnishee notice, for instance, they can't necessarily go and spread that across the other companies. They can only deal with the money from one company for that company, but they will attack the whole group at the same time. All right, so thank you. We have a question here. So post company liquidated, is there a minimum amount of funds the director must have in their personal bank account for the ATO to be able to issue? Absolutely not, Rob, is my understanding. That they don't actually know what's in the bank account. They're issuing a garnishee notice, hoping to get some money out of the account. Quite often they don't, because the directors often don't leave a lot in their personal accounts, but they don't actually know if there's money in the account when they issue a garnishee notice. So Stephen, to access that research, Creditor Watch is a very good source of a lot of that information. Not Credit Watch, Creditor Watch. But they have a mailing list that they send out business failure rate numbers out every month, and they've got some really good stats and stuff, so they're a good spot for it. But yeah, so go on a garnishee, they don't need any money at all, whether it's corporate or personal. In theory, they don't actually know what's in the bank account, because they don't have any legal right to go looking in your bank account, but they can certainly attack it and see what comes out of it. It's a little bit of a fishing expedition, I would think, is the way to put it. All right, well, if there aren't any other major questions, we're going to put a poll up which has got an extra question this time. We'd normally hey, be nice to me and say nice things about me part of the questions, but you'll also see down there a question on what topics you may want for next year. This is our last one for this year. I didn't think anyone would really want to listen to me on about the 20th of December. I'm sure you've all got better things to do at that time of year. But coming back into next year, if you do have anything specific, if you'd like me to go and source some specific guests, please let me know. If there's topics you'd like to cover, please let me know. I always, I hope that that there's some tidbits that come out of each one of these that you can use to help look after your clients and protect your clients moving forward. And I hope that you get something out of it. But if there's something specific that anyone wants, always more than happy to try and oblige where we can. So while you're doing those, filling in those questions, I'll start to wrap up by saying thank you all very much for supporting our webinar over the course of this year. And was it 4 years now? I've been doing these since COVID forced us into this path, and I really appreciate it. We do seem to get really good feedback that everyone enjoys us to continue doing, and we'll be back in 2025. If I don't get to catch up with you personally before Christmas, Merry Christmas to you all, and have a happy new year, and have a wonderful break. Have some downtime where you can. We, as I've said through the webinar, we will have resources available. You can always reach out to Hank or I if you have clients that all of a sudden life gets a bit crazy. But for nothing else, please be safe. Have a wonderful break. Merry Christmas, Happy New Year, and thank you very much for the support. I will leave, for anyone who needs to go, we'll call that quits, but I will leave it on because some people type like me and they need a little bit of time to actually finish filling in the questions. So I'll sit here like a frog on a log. Again, thank you. Merry Christmas, and we'll see you all in the new year, if not before.